The roots of the gold shortage, a look into history. The world is running out of gold. And history has shown us time and time again that when this happens, the results are never peaceful. You might think that your money is safe or that the financial systems governing your life are stable. But that belief is dangerous. It's an illusion designed to keep you complacent while the foundation of these systems rots beneath you. By the end of this story, you'll understand why the disappearance of physical collateral is the only signal that truly matters, and why it's happening right before our eyes. Once again, to comprehend what might happen next, we must first look back to the original crime scene. This doesn't begin on Wall Street, but in the marble halls of the Roman Empire. Somewhere around the 1st century AD, the Roman Empire, at its height, was the world's superpower, invincible and wealthy. However, despite its military dominance and prosperity, Rome was suffering from a hidden, fatal wound. The empire was hemorrhaging money. This wasn't just a theory. We know this because we have the records from the first financial whistleblower in history, Pliny the Elder. Writing in 77 AD, Pliny observed the empire's books and became alarmed. He realized that Rome was running a massive trade deficit with the East, specifically India and China. The Romans, obsessed with luxury, had developed a craving for exotic goods: Chinese silk, Indian pepper, Arabian pearls. These were commodities that would either disappear or degrade over time. But the East wasn't interested in Roman wine or olive oil. They wanted something of real, lasting value, hard assets. They demanded payment in solid gold and silver. Pliny estimated that Rome was draining 100 million sesterces every year to the east. This is roughly equivalent to 1 million gold coins leaving European circulation annually, never to return. Pliny famously wrote that we pay dearly for our luxury and for our women. Now stop for a moment and really picture that number: 100 million sesterces. This wasn't just ordinary spending. This was the physical removal of the money supply from the West. Rome was literally emptying its vaults to pay for spices that would be consumed and silk that would eventually rot. Gold was flowing east to India, while silver was sent to China, leaving the West in a massive liquidity vacuum. The emperor, though on paper the wealthiest man in the world, was watching his physical reserves deplete. Rome was experiencing the first global gold shortage. And just like today, the government couldn't admit they were broke. So what did they do? They decided to fake it. In 64 AD, Emperor Nero, facing a budget crisis and a shrinking supply of bullion, ordered the mints to reduce the purity of the silver coin, the denarius, to just 90%. It was a subtle theft, hardly noticeable to the average shopkeeper, but it broke a sacred trust. Once the seal of trust was broken, a floodgate opened. What followed was a slow-motion train wreck of monetary destruction. By 170 AD, under Emperor Marcus Aurelius, the silver purity had plummeted to just 75%. Why? Because real wealth was still flowing east to cover the trade deficit. While the costs of running the empire, the wars, the legions, and the ever-expanding bureaucracy kept rising, the government couldn't print gold, so they printed lies. The Roman Empire's financial collapse, a slow decline into fraud. As we continue our investigation into the roots of the modern gold shortage, we turn our attention back to the Roman Empire. The crisis Rome was facing wasn't merely a question of spending beyond its means. It was a crisis of trust. The emperors had learned an important, yet painful, lesson. When real money is in short supply, governments turn to deception to maintain control. It all began with the subtle, nearly invisible changes to the silver purity in Roman coins. In 64 AD, Emperor Nero's decision to lower the purity of the denarius coin marked the beginning of the empire's descent into monetary fraud. What initially seemed like a small change reducing the silver content from 100% to 90% set off a chain reaction. It wasn't immediately noticeable to the common people or the shopkeepers who accepted these coins. In fact, to the average Roman citizen, the coins still seemed to retain their weight and value. However, what the rulers were doing was laying the groundwork for the financial collapse that would follow. As the years passed, the silver content continued to decrease. By 170 AD, under the reign of Marcus Aurelius, one of Rome's most revered emperors, the silver purity of the denarius had dropped to a mere 75%. The average citizen, while noticing the gradual depreciation in the value of their money, couldn't fully understand the implications of what was happening. The state's betrayal was masked by the subtlety of the changes, but the damage was already being done. Why did the emperors allow this to happen? The reason was simple. They had no other choice. As we mentioned earlier, Rome was hemorrhaging money, primarily due to its insatiable need for luxury goods imported from the East. The Romans wanted silk, spices, and other exotic commodities, and they had nothing of equal value to offer in return. So they paid with gold and silver, gradually draining their treasury of real, tangible wealth. The silver that should have circulated within the empire was instead being shipped out to the East, where it funded a trade imbalance that was unsustainable. As the empire continued to spend its wealth, the costs of maintaining an empire of such vast size became overwhelming. The military expenses, wars, upkeep of roads and infrastructure, and the bureaucracy required to administer such a sprawling territory all contributed to a budget that grew larger and larger with no way to support it. The emperors found themselves with fewer and fewer resources to sustain the empire's massive expenditures. At first, they relied on traditional methods of raising funds, taxes. But the Roman citizenry, already burdened by the high cost of living and oppressive military duties, began to resist paying these taxes. Farmers and merchants, the backbone of the empire's economy, began to struggle. The government, in its desperation, resorted to a practice that would be repeated throughout history. When governments were on the brink of financial collapse, falsifying the currency. The more the Romans debased their coins, the less their currency was trusted, and the more their economy began to destabilize. With the reduction in silver purity, the value of Roman money began to plummet. By the 3rd century, under the reign of Emperor Aurelian, the situation had worsened so much that the standard coin, the annoninus, contained only 5% silver. The rest of the coin was made of base metal with a thin coating of silver to make it appear valuable. This was essentially a form of counterfeit currency. The annoninus was a coin that was worthless by weight, but still circulated as though it held value. In fact, it became increasingly common for citizens to notice that the silver would easily flake off the coin, revealing the cheap base metal underneath. This is where the situation took a dark turn. The government's attempt to keep the empire running with a fraudulent monetary system led to a catastrophic collapse. The trust that citizens had in the Roman currency evaporated. Not only did the price of goods begin to rise due to the growing devaluation of the currency, but the real impact was felt when the Roman legions, the backbone of Rome's military might, began to refuse payment in the devalued coins. The legions, who were already stretched thin fighting wars across the empire, began to demand payment in kind. They no longer trusted the coins issued by the emperor. They wanted goods, salt, leather, and clothing. Imagine the implications of that. The most powerful military force in the world, a force that had expanded the empire to the farthest reaches of the known world, was no longer willing to accept the government's currency. It was as though the entire empire was losing faith in its own financial system. When soldiers stop believing in the money they are paid, the state can no longer function. Rome's military might, once unchallenged, was crumbling from within. The emperor could no longer pay the soldiers who protected the empire, and this began the slow disintegration of the Roman Empire. The rise of barter, a forced regression as the economy spiraled downward and as more people refused to accept the devalued currency, Rome began to revert to an economic system that had been abandoned centuries earlier. Barter. Without the trust in money, people had no other choice but to exchange goods and services directly. A simple exchange of salt for grain, leather for cloth, or other such trades became commonplace. This was a regression to a primitive economic system, a sign that the empire was no longer functioning as it had in its prime. The transition to barter marked the beginning of Rome's financial collapse. The social and political stability of the empire depended on its ability to collect taxes, pay its soldiers, and maintain trade across its vast territories. But once the currency was devalued to the point where it was no longer accepted, these systems failed. Trade came to a halt. The empire that had once dominated the known world was now reduced to a shadow of its former self. The empire's vast infrastructure, its roads, and its military might were rendered useless in the face of a collapsing economy. This process of devaluation, fraud, and eventual collapse was not unique to Rome. It became a pattern that would play out again and again throughout history. Whenever empires or nations face financial difficulties, their governments are faced with the same dilemma. Either admit that the financial system is broken or fake it. And as history has shown us, most governments choose the latter. They choose to debase their currency, print more money, and hope that they can maintain the illusion of stability for a little longer. But history has also shown that this strategy never lasts. Eventually, the cracks begin to show and the economic system collapses. And when that happens, societies are plunged into chaos. The evolution of gold shortages from Rome to the medieval crisis as we progress through history. It's essential to understand that the patterns we see today, gold shortages, economic crises, and governmental fraud, are not new phenomena. They've been repeated throughout history, particularly during times of economic strain, when empires, nations, and societies face the uncomfortable reality of scarcity. Gold shortages, in particular, have played a significant role in shaping the course of human history, from ancient Rome to the medieval period and beyond. Following the fall of the Roman Empire, the world entered a period of political instability and economic fragmentation. The loss of centralized power in the West led to a collapse in trade, a decline in the value of currencies, and a retreat into regional economies. For centuries, the lessons of Rome's monetary collapse seemed forgotten. But as we move forward into the medieval era, we see history begin to echo itself. In the early Middle Ages, Europe was deeply connected to the trade networks of the East, much as Rome had been. However, by the 5th and 6th centuries, the fall of the Western Roman Empire had led to a decentralization of economic power, and many regions of Europe struggled to regain the same level of wealth and sophistication. The system of money-based trade that had been the backbone of Roman economic success was now in decline. What followed was a period of stagnation where gold, silver, and other precious metals became incredibly rare and highly valued. As we saw in Rome, the flow of gold from the west to the east became a consistent pattern. The early medieval period in Europe was marked by this imbalance. Europe had little to offer the East in terms of luxury goods or resources that would be in demand. But the East, particularly the Byzantine Empire and the Silk Road trade routes, had a demand for precious metals. Traders from the East took Europe's gold and silver in exchange for luxury goods like silk, spices, and other commodities that were prized in the West. But much like the Romans before them, the European powers were unable to fill the gap created by this drain. By the time we reached the mid-15th century, the symptoms of a familiar problem were beginning to manifest in Europe once again. Europe's obsession with Eastern goods, silk, spices, and rare commodities was causing another financial imbalance. The rich city-states of Italy, particularly Venice, played a central role in the financial system of medieval Europe, and they too were draining their gold reserves. The Venetian Republic had become the epicenter of trade between Europe and the East, and its vast wealth flowed into the coffers of the Ottoman Empire, Mamluks, and other Eastern powers. Venice became a great funnel for gold and silver, and the city-states' coffers swelled while Europe shrank. This trade imbalance became critical by the 1450s. Europe was consuming vast amounts of gold and silver to fund its trade with the East, but it had little to offer in return. The situation was exacerbated by the simultaneous depletion of Europe's gold and silver mines. The great silver mines of Saxony and Bohemia, once the heart of European coin production, hit bedrock. They ran dry, and suddenly, Europe was faced with the inability to generate its own precious metals to meet the growing demand. The Great Bullion Famine, a medieval economic crisis. This situation led to a phenomenon known by historians as the Great Bullion Famine. Between 1457 and 1464, Europe's gold and silver reserves dwindled at an alarming rate. The crisis wasn't merely about a shortage of metal. It was about a collapse of trust in the system that relied on it. In the absence of gold and silver, trade, taxation, and military efforts began to grind to a halt. Economic activity slowed to a crawl. The Great Bullion Famine was not an isolated event, but rather part of a larger global shift in the balance of trade and wealth. As the supply of precious metals diminished in Europe, the rest of the world began to take notice. While Europe grappled with this internal crisis, the East, now primarily represented by the Ottoman Empire, had access to the vast wealth of Africa and Asia. The Europeans, desperate to maintain their place in the global economy, sought to find new sources of gold. The concept of the Gold Coast, the region of West Africa, known for its rich gold deposits, began to emerge as the next frontier in the quest for wealth. The Portuguese were the first to push down the coast of Africa, hoping to find new gold sources and bypass the Muslim middlemen who controlled the gold trade routes. This was a direct result of Europe's economic desperation. The Portuguese were not exploring for the sake of scientific discovery or curiosity, but to solve a pressing financial need. This period marked the beginning of European exploration in earnest. The The Age of Discovery, as it is often called, wasn't driven by a thirst for knowledge, as we are often taught in school. It was driven by economic necessity. The exploration of Africa, Asia, and the Americas was a frantic, often violent, attempt to find the gold that Europe so desperately needed to survive. It was not a noble pursuit of knowledge. It was a desperate search for liquidity. As the Portuguese navigated the coast of Africa, they were not only looking for new lands, but searching for new gold sources. Their quest was a reaction to the economic crisis that had been triggered by the depletion of precious metals in Europe. They sought to bypass the traditional trade routes controlled by the Muslim empires and gain direct access to the gold-rich regions of West Africa. The Portuguese named the region the Gold Coast, not out of poetic inspiration, but out of sheer necessity. The name was a reflection of Europe's hunger for gold and its willingness to do whatever it took to secure it. Meanwhile, across the Atlantic, the Spanish were also looking for gold. The story of Christopher Columbus and his famous voyage is typically framed as a search for new trade routes and new lands. However, if you look closely at the diaries of Columbus from his first voyage, you'll see that his obsession was not with geography or science but with gold. Columbus was sent to the New World, not as an explorer in the traditional sense, but as a prospector. His mission was to find gold and bring it back to Europe. Columbus' letters to the Spanish monarchs are filled with references to gold. He wasn't charting new territories for the sake of discovery. He was looking for treasure. When Columbus returned to Spain after his first voyage, he brought back not just tales of new lands, but also stories of gold. This marked the beginning of a period of brutal conquest in the Americas. The Inca and Aztec civilizations were not simply conquered for their land or resources, they were liquidated. Their gold was extracted, and it was sent back to Spain, where it was used to replenish Europe's dwindling reserves. The consequences of the gold shortage, the destruction of civilizations, the influx of gold from the Americas, while it temporarily alleviated Europe's liquidity crisis, came at a high cost. The conquest of the Americas was brutal, and it resulted in the destruction of entire civilizations. The Inca and Aztec empires, once powerful and advanced, were wiped out, and their wealth was plundered. The gold that flooded back into Spain and the rest of Europe helped to reflation the global economy, but it did so at the expense of the lives and cultures of the indigenous peoples of the Americas. While Europe temporarily benefited from the gold influx, the long-term consequences of this wealth extraction were severe. The cycle of depletion and recovery would repeat itself throughout history, each time with disastrous consequences for the societies that found themselves at the mercy of a global economy based on gold. The wealth from the Americas did not make Europe stronger in the long run. Instead, it set the stage for future financial crises, as the lesson of unchecked greed and the unsustainable extraction of resources would continue to play out in the centuries to come. The arrival of vast amounts of gold and silver from the New World triggered a period of inflation in Europe. The influx of precious metals caused prices to rise, eroding the purchasing power of the average citizen. The abundance of gold did not lead to prosperity for everyone. It led to a redistribution of wealth, with the ruling classes benefiting the most. The common people, on the other hand, found themselves burdened by rising prices and falling wages. At the same time, the constant pursuit of gold led to increased colonialism and imperialism. The European powers, desperate for gold, began to expand their empires, seeking new territories to exploit for their resources. The search for gold and the need to maintain gold reserves became a driving force behind European imperial expansion, leading to centuries of global conflicts, colonization, and exploitation. The effects of gold shortages, a society on the brink of collapse. As we continue to unravel the history of gold shortages, we come to an understanding that these periods of financial instability had far-reaching effects. It wasn't just the rulers or the wealthy elite who felt the sting of gold shortages. It was the entire society. These economic crises wreaked havoc on everyday lives, transforming markets, eroding trust in the currency, and destabilizing entire nations. In this section, we will explore the societal impacts of gold shortages and how governments, desperate to maintain control, responded to the growing economic disaster. The breakdown of trust in currency. The first and most immediate impact of a gold shortage is the erosion of trust in the currency. The foundation of any monetary system is the faith that people have in the value of their money. When that faith is shaken, as we saw with the Roman Empire's devaluation of its coins, it's not long before people begin to look for alternative forms of wealth or trade. In times of crisis, people begin to hoard tangible assets, something they can hold and trust, leading to a panic that only exacerbates the situation. This is what happened during the Great Bullion Famine in the 1450s. With the flow of gold and silver from the East drying up, Europeans were forced to confront the fact that their currency had lost much of its value. As the money supply shrank, goods became harder to obtain, and prices began to rise. This period saw the beginning of inflation, not because goods were scarce, but because the money used to buy them had become nearly worthless. The merchants, once willing to accept coins for goods, soon began to demand payment in kind or in the form of more reliable assets, like grain, salt, or other physical commodities. In some regions, this led to a near-total breakdown in the market economy. It wasn't just that money lost value, it was that the very idea of currency itself was undermined. As the coins became less valuable, people stopped trusting the system altogether, and the idea of barter made a dramatic comeback. In the Roman Empire, the government's decision to debase the silver content of its coins also had the same result. As the silver purity continued to drop, the coins became increasingly worthless. Shopkeepers and merchants, who relied on these coins for trade, found themselves unable to conduct business as usual. In fact, as the price of goods surged and the purchasing power of the coins plummeted, many shopkeepers began to refuse coins altogether, opting for direct exchanges of goods instead. This devaluation, driven by the empire's desperate need to finance its debt, caused a ripple effect across Roman society. This loss of trust in the currency had lasting consequences. It created an environment where economic activity became increasingly fragmented and localized. People retreated into their communities, relying on barter or local forms of exchange rather than trusting in an increasingly unstable monetary system. This regression to a simpler economic model, based on the direct exchange of goods and services, was a stark reminder that without trust, the entire structure of a society's economy can collapse. Military and political ramifications. Another major impact of gold shortages was felt in the military and political spheres. Rome's military dominance, which had been the cornerstone of its empire, began to fray as its financial situation worsened. The Roman legions, who had been the empire's most formidable force, started to refuse payment in the devalued currency. This was not simply a matter of soldiers being paid poorly. It was a fundamental loss of faith in the empire's ability to maintain order and provide for its military. During times of financial instability, soldiers, who had once been proud recipients of the empire's gold and silver coinage, found themselves subjected to a rapidly deteriorating standard of living. In response, the legions began demanding payment in goods. This marked a significant shift in the power dynamics within the Roman Empire. The legions, once paid in precious metal coins, now demanded basic commodities like food, clothing, and leather in exchange for their service. This move from coinage to tangible assets was another sign that the monetary system had failed. As the empire's financial woes worsened, the government was forced to resort to extreme measures to maintain control over the military. In many instances, the emperors were forced to make increasingly difficult choices, cutting military funding and shrinking the size of the Roman legions. This weakening of the military had devastating consequences for the empire. As soldiers became more difficult to pay, the empire's ability to defend its borders and maintain its authority over its vast territories began to erode. This situation was not unique to Rome. In the 1450s, during the Great Bullion Famine, European armies and military powers faced a similar dilemma. The lack of gold and silver led to a decline in the ability of kingdoms to finance military campaigns. Without the precious metals necessary to pay soldiers, monarchs found themselves unable to raise armies or maintain their military power. In many cases, this led to an increase in mercenary forces, which were more flexible and less reliant on the traditional monetary system. However, this shift also came with its own set of problems. Mercenaries, who fought primarily for pay, were less loyal to any one ruler, and this further destabilized European kingdoms during a time of crisis. The breakdown in military power had serious political implications as well. In Rome, as the emperor's authority waned, local governors and military leaders began to assert more control over their own territories. The empire, once united under a single ruler, fractured into smaller, more fragmented regions as local leaders seized power. The central government's inability to pay and maintain the loyalty of its military led directly to the fall of the Roman Empire. This decentralization of power, born out of economic desperation, was a major turning point in world history. As the financial system collapsed, political instability followed, and the very fabric of Roman society began to unravel. A similar process played out during the Great Bullion Famine in Europe, where the lack of gold led to a fracturing of political power, with local rulers and city-states becoming more autonomous. This fragmentation of power weakened the political stability of Europe and contributed to the rise of new powers, eventually leading to the rise of the nation-state system that would dominate the modern era. Social unrest and the collapse of civilized life. The economic instability caused by gold shortages also had a profound impact on the social fabric of society. As the value of money plummeted and prices skyrocketed, the common people found themselves increasingly marginalized. Inflation, which was fueled by the devaluation of the currency, created severe economic hardship for those living on fixed incomes. The wealthy elites, who could protect their wealth through land, assets, and gold, fared much better than the average citizen, who saw their savings and purchasing power vanish almost overnight. As prices soared, the social divide between the rich and poor widened. In ancient Rome, as in medieval Europe, the wealthy continued to live in relative comfort, while the poor were left to struggle with rising costs and a lack of access to basic goods. This led to widespread social unrest. In Rome, the urban poor, who relied on the state for free grain and other basic provisions, found themselves unable to afford food as prices soared. Riots and protests became increasingly common as people took to the streets, demanding that the government do something to address the crisis. The social unrest was further exacerbated by the fact that the government was failing to maintain public services, such as the grain dole that had once provided for the citizens of Rome. As the currency lost its value, the government was forced to cut back on these programs, leaving the poor to fend for themselves. The result was a growing sense of frustration and anger among the population. Citizens who had once trusted in the stability of their currency and their government began to lose faith in the ability of their rulers to provide for them. In the medieval period, the social impact of the Great Bullion Famine was similarly severe. As gold and silver became scarce, and trade began to break down, the people of Europe were forced to adapt to a new economic reality. Barter, which had been largely abandoned in favor of coin-based systems, became the dominant method of exchange. This regression to a simpler economic model further isolated people from the rest of society. Farmers and merchants who had once traded goods across Europe found themselves increasingly limited in their ability to conduct business, leading to greater localism and a decrease in interregional trade. The result was a world that seemed to be falling apart at the seams. The breakdown of the monetary system, coupled with the social unrest and political fragmentation, created a perfect storm that contributed to the onset of the Dark Ages in Europe. This period of instability would last for centuries, during which the idea of a unified, centralized economic system would be all but forgotten. The government's response, seizing control and creating an authoritarian system faced with growing social unrest and the collapse of their economies, governments in both ancient Rome and medieval Europe had to respond. As the financial system faltered and the populace grew restless, the ruling elites had two choices. Either they could acknowledge their failure and let society collapse, or they could take drastic action to preserve their power. In Rome, the emperors, unable to admit the true depth of the empire's financial crisis, chose to take drastic measures to maintain control. The debasement of the currency was the first step, but it was followed by other authoritarian measures. Emperors increased taxes, confiscated land, and took resources from the provinces to fund the military and the bureaucracy. These actions further alienated the people, creating a vicious cycle of unrest and repression. Similarly, in medieval Europe, rulers responded to the economic crisis by seizing whatever wealth they could from the people. The monarchs, desperate to maintain their power, began taxing the poor more heavily, taking control of land and demanding more tribute from the cities. In some cases, kings and princes took matters into their own hands, seizing the gold and silver that remained in the kingdom, nationalizing resources and consolidating their wealth. But these measures only led to more instability. As the common people saw their wealth stripped away, they began to fight back. Peasant revolts, strikes, and uprisings became more common. And while the elites may have managed to hold on to power for a time, the damage had been done. Society had been irrevocably altered, and the grip of the ruling class had been weakened. Long-term economic impacts of gold shortages, from the 1450s to modern times. As we continue to investigate the recurring phenomenon of gold shortages, it becomes increasingly clear that these crises are not isolated events, but part of a cyclical process that shapes entire economic systems. The Great Bullion Famine of the 1450s, while a critical moment in European history, did not mark the end of gold shortages. It marked only the beginning of a new phase in the long, ongoing history of economic instability tied to precious metals. In this section, we'll look at how the crisis of the 1450s reshaped the global economy, how it paved the way for modern monetary systems, and how the ripple effects of this crisis are still being felt today. The consequences of gold shortages go beyond the immediate economic collapse. These shortages not only disrupted the flow of trade and wealth, but also contributed to the restructuring of global power dynamics, with shifts in the balance of power between Europe and other regions. The long-term ramifications of these shifts are still evident today in the structure of the global financial system and the way modern economies are built around monetary policies. The immediate fallout of the Great Bullion Famine, the mid-15th century, was a period of great turmoil in Europe. The Great Bullion Famine that peaked between 1457 and 1464 represented the culmination of a series of events that had been building up for decades. The shortage of precious metals caused a collapse in trade, disrupted agricultural markets, and crippled the feudal system that had governed Europe for centuries. The impact of the bullion famine was most acutely felt in the economic hubs of Europe, Venice, London, and the Hanseatic League cities. These cities, once centers of wealth and prosperity, found themselves unable to conduct trade as usual. Venice, which had been the gateway between Europe and the East, was hit hardest. The flow of gold from Venice to the East had slowed to a trickle, and the city-state found itself in a precarious position. The merchants who had once thrived on the export of luxury goods found themselves unable to secure enough precious metals to continue their operations. The ripple effect of this crisis spread throughout Europe. As gold and silver became increasingly rare, prices for everyday goods began to rise. This wasn't due to a lack of supply. There was still plenty of food and resources available, but because the money needed to conduct transactions had lost much of its value. This led to a classic case of inflation, where the prices of goods rose without a corresponding increase in value. The direct result of this inflation was that the common people began to feel the pinch. Farmers, who had once been able to trade their crops for money, now found themselves forced to accept less valuable goods in exchange for their produce. The gap between the wealthy elite and the poor grew wider. The monarchy, which relied on a steady flow of income from taxes and tributes, found itself unable to collect sufficient revenue from its subjects. This created a cycle of economic stagnation, where the ruling class became less able to govern effectively, and the peasantry became more disillusioned with the established order. The emergence of new trade routes and shifts in power. As Europe grappled with the economic consequences of the bullion famine, a subtle but significant shift began to occur in global trade. The economic crisis that had started in the 1450s ultimately gave birth to the Age of Exploration. European monarchs, desperate to find new sources of gold and silver to stabilize their economies, began to sponsor voyages of discovery. This was a period marked by European powers, particularly Spain and Portugal, seeking to expand their reach to new lands in Africa, Asia, and the Americas. The Portuguese, unable to secure enough gold from their traditional trading partners, turned to Africa. In their pursuit of gold, they ventured down the West African coast, where they discovered the Gold Coast, a region rich in gold deposits. By establishing direct trade routes with these gold-rich regions, the Portuguese hoped to bypass the Muslim-controlled trade routes that had previously monopolized the gold trade. The discovery of the Gold Coast was a direct result of Europe's desperate need for precious metals, and it set the stage for future colonial expansion. At the same time, Spain looked westward, seeking a direct route to the riches of Asia. Christopher Columbus, in particular, became the symbol of this desperate pursuit of wealth. While Columbus is often celebrated for his discovery of the New World, his true mission was to find gold. The Spanish monarchy, like its Portuguese counterparts, was in dire need of precious metals to restore the stability of its economy. Columbus's voyages were, therefore, not driven by a quest for knowledge, but by an economic imperative to find new sources of wealth that could help Spain recover from its financial crisis. These voyages of exploration, while often romanticized as acts of discovery and heroism, were, in fact, responses to the economic pressures created by the gold shortage in Europe. The need for gold drove European powers to expand their empires across the globe, triggering a wave of colonialism that would reshape the world for centuries to come. The wealth extracted from the Americas, especially the gold and silver from the Aztec and Inca empires, provided a temporary fix to Europe's monetary woes. However, it also had devastating consequences for the indigenous populations of the Americas, whose civilizations were decimated by disease, warfare, and exploitation. The rise of paper money and centralized control. The influx of gold from the Americas provided a temporary boost to Europe's economy, but it did not solve the underlying problem. The fundamental issue of gold scarcity had not been addressed. As the centuries passed, Europe's reliance on gold continued, but new financial systems began to emerge in response to the limitations of a gold-based economy. By the late 17th century, European nations began to experiment with paper money. The idea was simple. Instead of relying solely on gold and silver, governments could issue paper notes that represented a claim on future wealth. This allowed for a more flexible and expansive financial system. However, paper money came with its own set of challenges. If the public lost faith in the paper notes or if the government's gold reserves were insufficient to back the currency, the result was hyperinflation. The first significant experiment with paper money took place in Sweden in the early 17th century, but it was in England that the idea gained widespread acceptance. The Bank of England, founded in 1694, was established to manage government debt and issue paper currency. By issuing paper money, the British government could finance its military campaigns and expand its empire without relying solely on gold reserves. In the 19th century, the idea of a centralized banking system and paper currency spread to other parts of Europe and the United States. The creation of the Federal Reserve in 1913 marked a turning point in global monetary policy. The Federal Reserve, like the Bank of England, was given the authority to issue currency and control the money supply. This move signaled a departure from the gold standard, where currency was directly tied to gold reserves, and ushered in an era of fiat money. Fiat money, which is not backed by a physical commodity like gold, relies on the trust and confidence of the people. The value of fiat currency is determined by the government's ability to manage its economy and control inflation. While this system offers greater flexibility, it also comes with the risk of currency devaluation and the potential for economic collapse if the government fails to manage the money supply effectively. The Great Depression and the modern gold crisis, the abandonment of the gold standard and the rise of fiat currency allowed economies to grow and expand in ways that were not possible under a gold-backed system. However, as history has shown, the absence of physical constraints on the money supply can lead to inflation, speculation, and economic bubbles. The Great Depression of the 1930s was a direct result of the overexpansion of credit and the speculative excesses of the 1920s. As the stock market crashed in 1929, people lost faith in paper money and rushed to exchange their banknotes for physical gold. This run on gold destabilized the global financial system and led to widespread hoarding. The banking system, which had been built on fractional reserves, was unable to meet the demands for gold, leading to the collapse of major banks. In response to this crisis, President Franklin D. Roosevelt took a drastic step. He outlawed the private ownership of gold. In 1933, he signed Executive Order 6102, which required all citizens to turn in their gold to the federal government. This bold move was designed to stop the drain on the country's gold reserves and to stabilize the economy. Roosevelt's decision marked the end of the gold standard in the United States and the beginning of a new era of fiat currency. The end of the gold standard in the U.S. and other countries was a watershed moment in financial history. It allowed governments to expand their money supply without the constraint of gold reserves, but it also made economies more vulnerable to inflation and currency devaluation. The lessons of the past, the consequences of relying too heavily on gold, seemed to have been forgotten, and new economic crises would soon follow. The modern gold shortage, global implications. Fast forward to the 21st century, and we are once again facing the specter of a global gold shortage. While gold is no longer the central currency of the world, it still plays a crucial role as a store of value. The global demand for gold, driven by central banks, investors, and countries like China and India, is pushing the price of gold to new heights. Gold is seen by many as a safe haven asset during times of economic uncertainty. As central banks continue to print money, there are growing concerns about the long-term stability of fiat currencies. The value of the US dollar, the euro, and other major currencies is increasingly tied to the policies of central banks, which have the ability to inflate the money supply at will. This has led to concerns about the future of the global economy and the potential for another crisis similar to the Great Depression. The rise of cryptocurrencies, particularly Bitcoin, has added a new layer of complexity to the modern financial landscape. Cryptocurrencies are seen by some as an alternative to gold, offering a decentralized, digital store of value that is not subject to the control of central banks. However, like gold, cryptocurrencies are not immune to speculation and volatility. The future of gold and of money itself remains uncertain, as the world faces new challenges in managing wealth and resources. Conclusion: the cycle continues. As we look at the global economic landscape today, we can see that the cycle of gold shortages, currency devaluation, and financial crises continues to play out. The historical events we have explored from the fall of Rome to the Great Bullion Famine, the rise of paper currency, and the abandonment of the gold standard are not mere stories from the past. They are part of a repeating cycle that shapes our economic future. The economic principles that underpin the collapse of ancient Rome, the fall of medieval Europe, and the Great Depression continue to affect the modern world. As we face the challenges of the 21st century, it is clear that the lessons of history are as relevant as ever. When the physical collateral gold or otherwise vanishes, societies built upon it begin to fracture. The shortage always ends badly for those holding the paper promises. The only question is not if the cycle will conclude, but when. And when that time comes, will you be standing on the side of the desperate or the prepared? The future of money, a world facing gold shortages again. In the previous parts of this series, we've explored the cyclical nature of gold shortages throughout history. From the fall of the Roman Empire to the Great Bullion Famine of the 1450s, the collapse of the gold standard, and the rise of fiat money in the 20th century. As we stand at the edge of the precipice in the 21st century, the question we must confront is this: are we on the verge of another global financial collapse rooted in a gold shortage? And if so, what are the implications for the future of money, economies, and societies worldwide? The events we've witnessed over the past few decades, the explosion of digital currencies, the rise of central bank digital currencies, CBDCs, the ongoing search for gold as a hedge against inflation, and the increasing geopolitical tensions surrounding control over precious metals are all harbingers of a new phase in the ongoing cycle of gold shortages. As nations around the world grapple with inflation, fiscal instability, and the growing distrust in paper currencies, the question of physical wealth gold remains central to understanding how the global economy will evolve. A world of fiat money, the mirage of stability. When we look around the world today, the financial system is built on a foundation of fiat money. This means that currency, whether the US dollar, the euro, or the Chinese yuan, has no intrinsic value. It is not backed by physical assets like gold or silver. Instead, the value of fiat currency is determined by the trust people place in the issuing government and its central banks. This system has allowed for unprecedented economic growth, but it also carries significant risks. Since the end of the Bretton Woods system in 1971, when the United States officially abandoned the gold standard, the world has operated on a fiat currency system. Central banks have the power to print money, which has allowed economies to grow rapidly. Governments, businesses, and individuals can take on debt and leverage their resources in ways that were not possible under the gold standard. This has led to significant increases in wealth and technological progress, but it has also created financial bubbles, debt crises, and inflationary pressures. In recent decades, the ability of governments to print money without the constraint of physical reserves has resulted in a massive increase in global debt. According to the Institute of International Finance, IIF, global debt has soared to over $300 trillion in recent years. While much of this debt is held in the form of government bonds, corporate debt, and consumer loans, it is ultimately backed by nothing more than faith in the issuing entities. The value of money is determined by confidence in the system. But what happens when that confidence is shattered? The growing distrust in fiat currencies. Over the past several years, we have seen increasing signs of distrust in fiat currencies. The global financial system is teetering under the weight of massive debt burdens. and central banks are under pressure to address inflation, which has been rising in many countries around the world. The COVID-19 pandemic only exacerbated the situation, as governments around the world resorted to massive monetary stimulus packages and record levels of spending to keep economies afloat. The result has been a rapid increase in inflation, and the value of fiat currencies has come under scrutiny. The issue is not just inflation, but the potential for hyperinflation, where prices spiral out of control and the value of money deteriorates rapidly. We've seen this in countries like Venezuela and Zimbabwe, where inflation rates have skyrocketed and their currencies have become worthless. While the global economy has not yet reached this point, the fear of such a collapse is growing, particularly in countries with high debt-to-GDP ratios. One of the consequences of this growing distrust in fiat currencies is the increasing demand for gold. As central banks continue to print money, the purchasing power of paper currency declines. The average citizen, realizing the potential for currency devaluation, begins to seek alternative stores of value. Gold, which has been considered a reliable hedge against inflation for centuries, is once again gaining prominence as a safe haven. The role of gold in the modern economy. Gold, unlike paper currency, has intrinsic value. It has been used as a store of wealth for thousands of years, and it remains one of the few assets that holds its value over time. Gold is not subject to the whims of central banks or the volatility of global financial markets. When fiat currencies lose value, gold tends to increase in price, making it an attractive investment for individuals and institutions seeking to protect their wealth. In the wake of the 2008 financial crisis, central banks began to increase their gold reserves as a way to hedge against the risks of inflation and currency devaluation. Countries like China, Russia, and India have been particularly aggressive in their gold purchases, with central banks around the world amassing gold at a rate not seen since the 1970s. In fact, global gold reserves have increased by over 50% in the last 2 decades, as countries prepare for a potential financial storm. But the demand for gold is not just driven by central banks and investors. It is also being driven by the rise of cryptocurrencies. As digital currencies like Bitcoin gain popularity, some see them as an alternative to gold. However, unlike gold, cryptocurrencies are not backed by any physical asset, and their value is subject to extreme volatility. This has led some analysts to argue that cryptocurrencies cannot fully replace gold as a store of value, as they lack the stability that gold provides. Gold and the shift towards central bank digital currencies, CBDCs. As gold's role in the global financial system grows, so does the need for centralized control over currency. Central banks, which have traditionally held the power to issue currency, are now looking to digital currencies as a way to maintain control over monetary systems in a rapidly evolving technological landscape. Central bank digital currencies, CBDCs, are digital versions of fiat currencies issued and regulated by central banks. They are designed to work alongside physical money, but they offer the advantage of being more easily monitored, controlled, and tracked. CBDCs can also be programmed with specific features, such as the ability to limit how they are spent or the ability to expire after a certain period. The rise of CBDCs is a direct response to the growing distrust in fiat currencies and the need for governments to maintain control over monetary systems. By introducing digital currencies, central banks can more effectively manage the money supply, track transactions, and combat inflation. However, the introduction of CBDCs also raises concerns about privacy, surveillance, and government overreach. While CBDCs are still in their early stages of development, they have the potential to significantly alter the global financial system. Some countries, like China, have already begun rolling out digital currencies, while others, like the United States and the European Union, are exploring their own CBDC initiatives. These digital currencies could provide a way for governments to maintain control over their economies during times of crisis, but they could also deepen the divide between those who have access to digital assets and those who do not. In this new landscape, gold's role may evolve further. While it is unlikely that gold will ever replace paper money or digital currencies in the modern economy, it may become a key reserve asset for central banks and private investors alike, acting as a safeguard against the risks of fiat money and digital currencies. The geopolitical implications of gold and fiat money. The geopolitical landscape is also shifting in response to the growing role of gold in the global economy. As countries increasingly turn to gold as a hedge against inflation and currency devaluation, control over gold reserves becomes a strategic priority. Countries with large gold reserves, like the United States, China, and Russia, are positioning themselves as economic powerhouses that can weather the storm of financial crises. At the same time, the United States' dominance in the global financial system is being challenged. The US dollar has long been the world's reserve currency, but its status is increasingly under threat. As countries like China and Russia increase their gold reserves, they are also seeking to bypass the dollar in international trade. The rise of the Chinese yuan as a potential global reserve currency is a direct challenge to the dollar's hegemony, and the increasing use of gold in international transactions is part of this shift. This geopolitical shift is not just about gold. It is about the future of global power. Countries that control access to precious metals like gold will have a significant advantage in the New World Order. As gold becomes more scarce, countries will fight to secure their share of global reserves, potentially leading to new economic alliances, trade wars, and geopolitical tensions. The future of gold shortages. Will we see another collapse? As we look to the future, it's clear that the cycle of gold shortages is far from over. While the world has moved away from a gold-based monetary system, gold remains a key asset in the global economy. As governments continue to print money and accumulate debt, the risk of a global financial collapse tied to gold shortages remains high. The instability of fiat currencies, the rise of digital currencies, and the growing demand for gold all point to a future where the value of money is increasingly uncertain. The question is not whether we will experience another gold shortage, but when. The global financial system is currently in a fragile state, and the signals of a coming collapse are already evident. Central banks are printing money at unprecedented rates, inflation is rising, and the demand for gold is increasing. It's only a matter of time before the system reaches a breaking point. When that happens, the question of who will be standing on the side of the prepared will become all the more urgent. Those who hold physical assets, particularly gold, will be in a much stronger position than those who hold paper money or digital currencies. Gold, with its long history as a store of value, will once again prove its worth as a safeguard against economic collapse.